Hi there, welcome to kneppyinvests. In this video, I'm going to be talking about two trading updates companies released on the ASX in the week May 10 to 14. Those two companies are Paragon Care and Perenti. Particularly the Parenti trading update was really interesting because it had some macroeconomic factors in there that I do believe are important moving forward. In particularly, the mention of a tightening labour market which is affecting their margins. And that's interesting because the government has said, actually not the government, the Reserve Bank has said they don't think there's going to be any wage increases the next few years, so they won't have to increase the interest rates. And if we do see this tightening labour market become economy-wide, which will mean wages will have to be raised, and that will lead to inflationary pressures. So the Reserve Bank could be completely wrong. And if they're completely wrong, we'll see interest rates rise considerably earlier than they're forecasting. And that's going to be very interesting to see how that plays out. It's not a definite at this point in time. I don't know how this is going to play out. But this is really the first sign we've seen of a tightening labour market. Parenti, and if you don't know who Parenti are, they used to be called Ausdrill. It's not that big lizard because that big lizard is spelt with an E at the end, if I remember correctly, but it's probably a homage to that lizard anyway. So Parenti used to be called Ausdrill, and Ausdrill is a better name because as soon as you read or see Ausdrill, you know what sort of business they're in. They are a mining services business. So they released their operational update on the 13th of May. And this is really interesting reading. I love this announcement because you get so much out of this about what's happening in the economy as a whole and what could happen, and what could happen could affect the way you invest in the future or the next year at least. Anyway, so the market reacted to this announcement. This was a profit downgrade, and the market punished Parenti's share price, and it decreased 30% on the day they released it. So it's all about the outlook for the second half earnings being softer than the first half because of three reasons. COVID-19, a stronger Australian dollar, both of those understandable enough, and tightening in Australian labour market, which is the most interesting thing about this announcement. So what does a tightening in the labour market mean? It means there's more demand for labour than supply. If there's more demand than supply, wages rise. If wages rise and you can't control the product is selling, or I don't think Parenti has a product, it means your margins come under pressure. So lower margins means lower profits. So that's interesting enough that the labour market is tightening and wages are rising. Reserve Bank has mentioned recently they don't expect wages to rise for the next 3 years. So they could be wrong on this account. The other really interesting thing about this announcement, they expect these headwinds in the labour market to continue for the next 12 to 18 months, resulting in a softening outlook for financial year 22. I didn't care about that. But it was the fact they expect these headwinds to continue for the next 12 to 18 months. And that is suggesting to me that wages could be rising, at least in this sector, for a considerable period of time. And that is completely counter to what we're being told by the Fed and the Reserve Bank in Australia. So if you get a tightening labour market, wages rising, if wages start to rise, that puts inflationary pressures out there, and that leads to inflation. We're already seeing inflationary pressures out there right now with input costs. So supply pressures, meaning when companies make their products, their supplies into those products, those prices are increasing, which means if they have pricing power, they can pass off those increasing into the supply costs onto the consumer. That's inflationary pressures. Wages rising are inflationary pressures. We've been told by the Fed and the Reserve Bank that these inflationary pressures are only transitory. They're not going to be lasting very long. Parenti are telling us in this announcement that these pressures are going to last for the next 12 to 18 months. That's telling me Reserve Bank and the Fed could be wrong. I'm only saying could be right now, but they could be wrong. If they are wrong, they're going to have to raise interest rates way earlier than they are telling us. And that could have serious complications and impacts on the overall share market, and will have serious implications on the type of companies you need to invest in. Now on to the charts for Parenti, and before I get into the 9-year monthly chart here, just a few of the financial facts around Parenti, and these are interesting. Market cap 500 million, revenue 2.1 billion in the trailing 12 months, and operational cash flow of 337 million. So when you look at the price to sales ratio, we're looking at 0.25, and operational cash flow, they do have about $1 billion in debt. So the enterprise value, I think, is 1.5 billion. So even then, the EV to operational cash flow is less than 5. So those ratios are quite attractive. And when you look at those ratios, you might think, oh, good time to buy, it's cheap. But they put out an announcement on the 13th of May saying the company is under attack by these issues, which suggests that those numbers are going to decrease in the next 12 months or even longer, 18 months, maybe 2 years. And that's why the share price is decreasing right now. That's why the market is selling off of Parenti. But when you look at the 9-year monthly chart, and when you look at this 9-year monthly chart, it just tells you this is not the buy and hold sort of company. You don't buy it right now and expect it to hold it for the next 20 years. There is a time to buy, which will say a time and price to buy, and a time and price to sell. And a good price to buy into Parenti is whenever the share price gets below about, we'll say 60 to 50 cents. It hasn't happened that often in the last 9 years, and every single time it gets below 50 cents would be a good time to buy. So it happened in 2015 and again during the COVID-19 financial panic. And right now it's 71 cents. So it's heading towards the price when it might be a good time to buy. But right now, their share price is under attack, and we don't know how far it has to fall. And we can see that in the next chart. Now on to the daily chart for Parenti. Nothing really exciting here at all. There was a potential breakout in early November at around $1.20, and the share price went to $1.50 by the end of February. But it looks like once they released their financial report during the half year, the market didn't like it, and the share price was under attack. So that was a sell signal there, and we have seen the share price just go down ever since then. And of course, when they released this profit downgrade, we did see the share price pull back 30%. So just looking at the 1-year daily chart, there's no reason to buy into this company just yet. Even though the share price is significantly lower than it was before, isn't a reason to buy into a company. What you want to see is a shift in sentiment. What you want to see is a turnaround in the share price. What you want to see is some positive announcement from the company that all these macroeconomic factors are no longer affecting the margins of the company. So until we see that, we don't know how long all these pressures are going to affect the company's business. So just remain patient. There's other opportunities out there to buy into at this point in time. The second company I want to talk about is Paragon Care. This is a company I've owned in the past, but they were an acquisition-hungry company, and there were some troubles with those acquisitions. So they've had a lot of headwinds in the past few years. We've seen the share price come under significant attack. Two key highlights they mentioned in this company update on the 10th of May. I thought they should have switched these key highlights around and really focused on the improved operating performance, and then maybe just focus on the new year, 3-year bank facility with NAB second, but they thought the bank facility was the first thing they should mention here. There was one thing I was concerned about this 3-year bank facility. They mentioned new covenants support future growth, acquisition opportunities, and dividends. That's concerning to me, because if you're thinking of using debt to pay dividends, that's a massive red flag. I would not even think about buying into a company that uses debt to pay dividends. But what I think they mean here is this bank facility would support them growing in the future, and with their growth, they'll be able to reintroduce dividends. They won't pay the dividends through their debt. That's what I think they mean here. And if they do mean that, then that's okay. But never buy into a company that pays their dividends through their debt. Annual savings of $575,000 per annum, that's okay. I think they do have something like $100 million of debt, if I remember correctly. So they do have a fair bit of debt, this company. Improved operating performance. So I'll go through these numbers in the next slide, but financial year 21, year-to-date EBITDA up 79% to 21.2. Now, the reason we do see improving EBITDA isn't because the company is growing, it's because of cost controls. And cost controls can't last forever. The company needs to grow revenue to be sustainable when it comes to growth of the company. So I'll talk about that in the next slide. Now let's look at some of the numbers they provided in terms of growth rate of revenue, operational cash flow, and EBITDA. So they're very excited about the fact they are growing EBITDA, but by looking at these numbers, we can draw some conclusions about how they achieved this EBITDA growth. So first of all, look at revenue growth. And revenue for the third quarter was at 58 million, 0% growth over the previous corresponding period. It even gets worse when you look at the financial year to date revenue. 173 million, it's actually gone backwards. They've lost revenue in the past financial year. So that actually is a concern. I like to see companies growing that revenue because revenue growth is sustainable for an infinite amount of time. Margins at 38.7%, stable, that's okay. At least gross margins aren't decreasing, so that's a positive, I suppose. Operational cash flow in the third quarter has improved from 1.7 million to 13.5 million. Now we know for the simple fact they aren't improving revenue. If they are improving operational cash flow, that means they must have decreased costs quite substantially. And the thing about decreasing costs, it can't continue forever. There's a certain point in time where they're going to have stable costs, which means revenue growth is the most important thing here. So you can control costs for a period of time, that's okay, but it's not sustainable over a lengthy period of time. And EBITDA third quarter growing from 2.7 million to 6.4, and EBITDA year to date going from 11.8 million to 21.1 million. So we know just by looking at these numbers that they are controlling costs, and that's how they got the EBITDA growth and the operating cash flow growth, and we can confirm that by management with this statement. This improved operating performance reflects the successful execution of the company's cost rationalization program, which led to a significant reduction in employment costs, marketing costs, and administration expenses. That's cost rationalization program can't continue forever. They're going to have to, at some point in time, focus on growing revenues. I always love to look at charts for a company because if you can't look at a chart, if you refuse to look at a chart for a company that you're thinking of buying into, you're really going in blind. So this is Paragon Care 5-year weekly chart. Before I look at the chart, just some financial matters. So when you just look at the finances of Paragon Care, it does actually look attractive. Market cap of 79 million, revenue of 226 million in the trailing 12 months, and operational cash flow of 29 million. They do have about $100 million of debt, so you have to take that into account as well. Now to the chart. So this company was acquisition hungry, as I mentioned before, and the share price got to a high of 95 cents. So the market was excited about all these acquisitions this company was doing. And then I don't really know the full story, but a few of those acquisitions I think went wrong or badly. And that's why the share price was under attack for a long period of time, for about 2.5 years to 3 years. So it went from a high of 95 cents to a low of 10 cents during the COVID-19 financial panic. But the share price has settled and it is going sideways, particularly over the past 6 months or so, around 20 to 30 cents. And it does look interesting right now because we started to see all those three moving averages, which is the 50, the 20 and the 10-week moving averages come together. And that's the first sign that if there is a share price breakout, that would be a buy signal, particularly if that share price breakout is on positive news. So that's the one thing I'm waiting for now, because we are seeing the possible shift in sentiment with this company. And what I want to see is a positive announcement before we see the share price move into an uptrend. When we look at the daily chart for Paragon Care, you don't see much here at all. In fact, share price has been going sideways through this time period. So no discernible trend at all to get excited about. When they did release that announcement on the 10th of May, there was a little bit of excitement that came in the market. We can see a bit of a spike in the volume. Share price did run up a bit. As soon as the share price got above 26 or 25 cents, there was a little bit of selling that came into the market, which is understandable. Because if you go back to February, there would have been a fair few people who bought in between 26 and 30 cents, and they saw their opportunity to get out of this dog stock, because a lot of people believe if the share price goes lower from when they bought in, that automatically makes the company a dog stock, even though if the company may not be a dog stock. It's just human psychology. Hope you don't think like that if the share price decreases from when you bought in. Anyway, so there's a little bit of pressure in the share price once it gets to between 26 or above 26 cents. So that is a resistance zone. So we need the share price to move through that resistance zone. And what would take for the share price to move through that resistance zone is some good buying, some good volume coming through. Another positive announcement would be helpful right here. So the share price gets above 30 cents, that would be the time to buy into Paragon Care, because that would be confirmation of a potential new uptrend. And I think you'll see that on the daily chart, and also to confirm the potential new uptrend on the weekly chart as well. So at this point in time, just keep an eye on this company if you like it. Wait for the share price to move through that resistance zone, and that's the time to buy. No point buying until then, because the share price has just been sideways for the last 6 months. That is all I've got on this video about two companies who released trading updates during the week May 10 to 14, Perenti and Paragon Care. If you have a question about either of these companies or any other company on the ASX, NASDAQ, the New York Stock Exchange, the Germany Stock Exchange, if you have a question about Lindt chocolates, I'll answer any question you have to the best of my ability, because I'm not a financial advisor. So if you do need a financial advisor, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.